Bonds have sold off over the last few sessions. Buying opportunity?
Absolutely, without question. Essentially, the reasons that we've seen for the bond sell-off are understandable in the sense of market dynamics, but I don't think they really are getting at the underlying, causes, problems, macroeconomic outlook. Essentially, what we've seen is some sentiment factors which have sort of shifted the needle quite quickly from it's the end of the world to wow, there are no problems, and that's a massive overreaction. We have not really dealt with any of the problems. It concerns me when I hear some of the Federal Reserve communication with respect to the economic outlook, because I still don't think they've quite grasped exactly what's going on under the hood.
Where do I get the biggest bang for my buck if I am buying? Where do I buy?
Treasuries.
Okay.
Essentially, there's some of the things we do in bond world are complicated, technical, mathematical and full of jargon, and some things are quite straightforward. The central bank that has the most room to cut before it gets to zero is likely to be the most attractive bond market to own. When that also happens to be the market which issues the reserve currency, that combination tends to be the right place to be if you believe, like I do, that we're headed to a recession.
James, on a day like today, what's more important to a market that's looking for maybe the cycle to turn? Is it something like the productivity data that we got that disappointed? Although commentators have pointed out that with non-farm payrolls as strong as they are and growth as weak as it is, of course productivity is going to give at some point. Or is it trade?
Yeah, hey, Vonnie. I think it's neither of those. I would agree with the analysis that you described, which is to say that essentially productivity as described economically in theory and productivity as measured are two completely different concepts. Productivity as measured is one number divided by another number. It really doesn't tell you anything about productivity as Adam Smith would have described it in 1776. So I don't think we should be looking at that at all. It's a remainder. It's a sort of mathematical formula. By the same token, I truly do not believe that trade policy has been the biggest driver of the global manufacturing and slightly more broad economic weakness that we've seen over the last 12 or 18 months or even more. So I don't think either of those two truly are the story. I think essentially what we're seeing is a global economy which is reacting to different policy choices in the Chinese domestic economy, having an impact on the global exporting, manufacturing, trade-sensitive, pro-cyclical sectors. And then the combination of that and the fact that US unemployment cannot fall much further, certainly cannot fall at the pace that it has been falling. And the confidence shock combined with that fact means that there really is not much left in the engine of global economic growth at this stage.
Well, James, is this a one-time shift or I'd say a secular shift? And if it is something like a secular shift, how should bond investors be playing that? How should they be treating that?
Yeah, I mean, bond investors are going to have to sort of stare down the barrel of something that looks quite V-shaped, I think, because there are a couple of things that have been going on. One is, the secular stagnation, low growth thesis. The other is the complete absence of inflation. I've just described a situation where I think China is undergoing what looks like a secular shift in the pace of its growth, but also the makeup of its growth. It's going to be less impactful for the global economy. The combination of all of those things looks like low yields, flat curves forever. The problem that you have is that the other secular trend which we've observed over the last 10 or 20 years has been this globalization, outsourcing, low wage economy trend, and that's been very disinflationary. That's essentially what central bankers have been fighting for 20 years with tools which are completely inappropriate. And I think we're getting to the stage for either political or just economic reasons where that's starting to run its course, and that means that secular structural disinflation trend is running its course as well. So I don't expect inflation to rear its ugly head just yet, but I certainly do not believe that inflation is dead. And if we are to head into a political sphere whereby the left becomes more dominant, then there are some inflationary forces out there which are likely to reappear, and you don't want to own fixed income in that environment. So for me, for now, it's still a falling yield, flattening curve trend, but I do not discount, I do not doubt that there are likely to be environments in the future which are not as bond friendly.